to another edition of Investor's Guide, where we guide you and help you on how you can make your money work for you. So our focus has continued to be on debt funds for the past few episodes, and today we're going to talk about a very important category of debt funds, especially if you're looking to invest for the short term with a short-term investment horizon, and this category is called as ultra short-term duration funds. So how does it fit into your portfolio? What is a fund manager's strategy as far as this category is concerned? To understand all of that, joining me is Feroze Azeez of Anand Rathi Wealth Management. Feroze, thank you for joining us on this episode of Investor's Guide. So Feroze, we've spoken about the medium to long-term duration funds. We've spoken about the short-term duration funds. Now we are focusing on the ultra short-term duration funds. And if you can help us understand how this category really works and what does it really mean for an investor and what is the kind of time horizon one is usually looking at for this.
Avni, when it comes to ultra short-term duration funds, these are funds where the fund manager is mandated to buy a portfolio of bonds which do not exceed 6 months and which is not lesser than 3 years of duration. Duration is nothing but the time frame, weighted average time those bonds will give back the cash to the bondholder. So 3 to 6 months is the strategy of a bond portfolio being created by the fund manager who manages an ultra short-term bond fund. Currently, there are about 27 odd schemes, and the average time each of these schemes put together is about 4.6 months. So 4.6 months. So that clearly gives an investor a perspective of what's the kind of time frames these funds are rightly chosen for. It is between 3 and 6 months. If your investment time frame is less than 2-3 months, then this is not the category for you. If it's greater than 6 months, then you can do better than this. So 3 to 6 months is a good indication, with an average maturity less than 6 months is what the current category shows. There are several schemes. The total assets this category manages is 74,000 odd crores in this category, and it has seen reasonable amount of inflows over the last 4-5 months. So hence, it is the flavor of the day.
All right. In terms of choosing, a fund, from specific fund from this category, if an investor needs to do that, how does one approach it? Do you look for funds which have a majority of, say, AAA rated papers, or do you choose a fund with some other, input in mind before deciding? What is the advice here?
You've rightly pointed, Avni, one of the biggest criteria to choose a fund is after trying to match the fund manager's time frame with yours as an investor. The second thing to check is how much is there in very, very safe securities, which is sovereign, which is government backed, state government, central government, RBI backed. And then you have these really large AAA rated companies. This category as a whole, because it's a very short period which the fund manager is investing on behalf of the investors, has only 6% other than AAA and government papers. So that's a very small proportion. Out of the 74,000 crores, all these fund managers collectively have just put 6. So that's one important criteria to keep in mind. And the second important criteria is the expense ratio, because these schemes will not give you a very, very high return. They'll give you a return in the range of 4 to 5% as of today, if held for the next 3-4 months. So spending too much money on the fund manager expense is not a bright idea. So to go for the lowest expense or the least expense in the bigger funds, there are these bigger asset management companies, Aditya Birla, Kotak, HDFC, SBI, ICICI. These are the top 5 ultra short bond funds. Choose any of them which has the lowest expense and the highest proportion in government and AAA paper.
Right. And how does this differ from liquid funds? Because that's again another category of funds, and we'll discuss that in depth a little later on another episode. But just to understand the difference between the ultra short-term duration funds and liquid funds as well.
See, the liquid funds are for a very, very short period. If you have about 10 days of investing period, then liquid fund is a better idea. You should not be going for an ultra short bond fund. If that period exceeds 2 to 3 months, then you can try and make that 0.5% or 1% more return, which an ultra short bond fund has the capacity to pay in the current circumstance. So that's the key distinction. The time frames which the investor is wanting to part his money with is going to be the criteria, whether liquid funds make more sense for that portion of your money, or an ultra short bond fund would be a better choice. Longer the period, greater than 20 days, 1 month, 2 months. After 2 months, then definitely ultra short bond funds could be considered.
Right. So as an investor, in terms of liquidity or in terms of access to this to my funds in this category, is it something that I can be assured that I will, get back at a certain point in time? If I say I have a horizon of 6 months and that I know that I'm going to need the money in 6 months, how would that work? Can I be assured that the liquidity aspect in this category?
Yes, Avni, liquidity generally in all mutual funds, every time you send a redemption at the NAV, you get the money latest by 3 days after having requested on any working day. In fact, in an ultra short bond fund, the price movements are going to be minuscule. So you'll not have to be worried that if your need of your money arises during the bad time, it's not going to be subject to too much of price variation. So it's liquid, the price is very stable, and you get the money in T+2, by which you mean on any working day, if you give a request on that day, 2 days later, you can see the money in the bank account. So that's the kind of liquidity which is available on these mutual funds, along with the rest of them, which are also liquid.
Right. And in terms of returns, what kind of returns can one expect for this category of funds, considering that you are going in with a very short investment horizon?
So the timeframes the returns which Avni, an investor can expect under the fallen interest rate environment should not supersede 4.2% or 4.5%. That's the highest expectation one could have. On the lower side of 4%. So 4 to 4.5% is what the yield of the bonds which these fund managers hold on behalf of the investors currently. And that should be the expectation what an investor should have.
All right, we'll leave it there, Feroze. Thank you so much for joining us to help us understand what ultra short-term duration funds are. And we're going to continue over the next few episodes to decode all of these different debt categories and give our viewers a better understanding of how these categories fit into your portfolio and what are the things that you should be aware about while choosing what goes into your portfolio. On that note, it's a wrap. Thank you so much for joining us on this edition.